What's up, everybody? Ryan Pulis here from the Pulis Group with today's real estate tax tips. We're a tax and accounting firm specializing in tax planning for real estate investors. Today, we're going to discuss cost segregation studies and how they can benefit real estate investors. So what is a cost segregation study? Cost segregation is a process of reallocating the cost of a property among the various components. Values assigned to personal property and land improvements, which are depreciated at a faster rate than the building itself. This is generally handled with an engineering-based study for larger properties. A common misconception is that smaller properties cannot benefit from a cost segregation study due to the cost. While it's true that the cost of an engineering-based study may outweigh the tax benefits for a small property, you can still perform what's called a mini cost seg. So a mini cost seg is basically a residual estimation. There are companies out there that can do this for a price of around $500 or so, which is much less than the more typical engineering-based study used on large properties. Now, what are the benefits of a cost seg and why would you want to perform one? A cost segregation allows you to accelerate depreciation, which leads to larger deductions. Buildings are generally depreciated over 27 and a half years for residential properties or 39 years for commercial properties. Cost segregation will often carve out about 20 to 30% of the building cost and allocate it to 5, 7, and 15-year property. 100% bonus depreciation allows for the immediate expensing of property with a life of 20 years or less. So buildings aren't eligible for bonus depreciation because their recovery period is greater than 20 years. But bonus depreciation is allowed for the personal property and land improvements. Personal property is typically the 5 and 7-year property, and land improvements are 15-year property. So both eligible for the bonus depreciation. Let's take a quick look at an example to demonstrate how this works. So Johnny buys an apartment building valued at $1 million. We're ignoring the cost of land for this example. He would normally take $36,000 in annual depreciation. So $1 million divided by 27 and a half years, assuming it's residential. That's where we get the $36,364. Johnny decides to use the cost seg study to break down the $1 million into the following buckets. So we end up with 5-year property at $150,000, 15-year property, land improvements, at $100,000, and 27 and a half year property, which is the residual allocated to the building of $750,000. So without bonus depreciation, this allocation is still beneficial because it provides for first year depreciation of $62,273, which is a $30,000 makers, which is a depreciation type, your typical tax depreciation for 5-year property. The $5,000 maker's depreciation for a 15-year property, and we'd have $27,273 straight line depreciation on the 27 and a half year property. That's that building residual. So that's a $25,000, almost $26,000 increase over the first year depreciation expense without using a cost segregation study. So the $62,000 less the 36 that we talked about, that would have just been straight line for the entire $1 million. That's where we're getting the increase of almost $26,000. To make things even better, bonus depreciation allows Johnny to deduct the full cost of the 5 and 15-year property in year one. So that brings the total year one depreciation to $277,000, just over. That's a significant increase in the first year depreciation deduction, and it's made possible by doing the cost segregation study. Now, while the increased depreciation deduction is great, you want to be sure that you're able to use it before going forward with a cost segregation study. The passive activity loss rules prevent taxpayers from using passive losses to reduce non-passive income like W-2 wages and active business income. Passive losses can only reduce passive income. Losses in excess of passive income are generally suspended and carried forward to future years to be used against future passive income. Rental activities are considered passive by default, even when you materially participate. This is what's referred to as the per se rule. There are exceptions for taxpayers with income of less than $100,000 and taxpayers that qualify as real estate professionals. There's no income limit if you qualify as a real estate professional. So taxpayers with income of less than 100K can deduct up to $25,000 in passive losses against other income. That $25,000 allowance is phased out as income reaches $150,000. Once you're over that $150,000 threshold, your passive losses are only able to be used against passive income and are suspended, unless you qualify as a real estate professional. We discussed real estate professional status in another video. I suggest checking that out if you're not familiar with it. And one other exception, when you sell a property, all your passive losses are freed up as long as it's a complete disposition of the property or activity. Now, if you're paying for a cost segregation study, you want to make sure you can use these losses. So if you're in a position where all of your passive losses remain suspended and you don't have passive income to offset it, maybe going forward with a cost segregation study is not the best idea for you. And some investors may still prefer accelerating depreciation even if the losses are temporarily suspended, because they have a plan on how to utilize those losses in the future, and that's something we can help you with. Or possibly they have passive income from other sources that can be sheltered by the rental activity and would like to pay for the cost seg study to accelerate those depreciation deductions and shelter that income. So to recap, a cost segregation study accelerates depreciation by allocating value to assets with shorter recovery periods than the building itself. This leads to a larger depreciation deduction and the ability to immediately expense 5, 7, and 15-year property using bonus depreciation. Be sure you understand the passive activity loss rules and how that will impact your tax plan. That about wraps up our discussion today on cost segs. I hope this video was helpful. Feel free to comment below and hit the like and subscribe button. We are taking on new clients and will review your prior year tax returns for planning opportunities. If you'd like to work with us, then hit us up on our webpage at thepulisgroup.com/contact. That's ThePulicegroup.com/contact. Thank you.